Now, when and why do you want a hard money loan? It's four reasons. You don't qualify. This is a guy that looks like Jason, myself, or Ravi that's looking at your documents and saying, hey, you just quit your job. Hey, you wrote off everything. Hey, you're self-employed. You don't qualify for the loan. Now, you can get private money financing when you, as an individual, don't qualify. The second is the property doesn't qualify. And this is the main reason that investors utilize private hard money financing. Is the house was distressed, you cannot go get financing at a bank, at a credit union. So your only option is you can buy it cash, or you have a rich aunt or uncle, or you borrow private hard money. So reason one is you don't qualify. Reason two is the property doesn't qualify. Reason three is you want to close fast. A lot of times these deals that we have, they're deals that need to close by Thursday. They're deals that need to close by next Friday. We don't have the option to go to a bank and say, hey, I have this contract. I've banked with you for the last 20 years. Can you please give me financing on this? Because if they say yes, it's going to take them 30, 45 days. Well, in that 30, 45 days, not only has somebody else bought it, but they've rehabbed it and they're getting very close to putting it on the market. So you need to close fast. And if you don't have your money to do it, well, financing is what? You're buying money. So no different here. You're buying money to buy a property. And then you want to save your own money. If you find a property, $200,000 against $100,000 in repairs, and you want to buy that property, you have to put down 20%. And then you have to repair the property with your money out of pocket. So 20%, $200,000, $40,000 plus $100,000. You're out of pocket $140,000. There's only so many of those deals that you can end up doing. So again, you don't qualify, the property doesn't qualify, you need to close fast, or you want to save your capital. All right, where to find deals? How many realtors do we have in the room? I know Mary's right here. 2, 3. So they're everywhere. You can find deals through realtors. You can find deals online. I am a big fan of finding deals online. That's a motivated seller, is it not? There's a seller that wants to sell a property. Now it just comes down to the price that you're able to acquire the property with. Over the past few years, Facebook has gotten huge with off-market deals. Wholesalers realize now, instead of having to go to events like this and go around and collect buyers' names on their buyer list and then go back home and put together this real nice email to send it out, they can just send the property out on Facebook, has tons of buyers. So we see it all the time with clients coming to us. How did you find a deal? We found it online. And then where else? Investors, look, Patrick has properties for sale right now that he'll owner finance to you with less than 20% down. Jason and Ravi are going to talk about here in a little bit. Did I say that right? Yes, sir. So later, Jason and Ravi are going to talk about debt service coverage ratio financing and conventional financing. Both of those financing options, it's 20% down minimum. And then we always want you putting down 25% because you get better rates. So not a spoiler alert, and then we're going to ask you for documents. We're going to do appraisals, all that stuff. You can buy it directly from an investor, owner finance it to you. Wholesalers sell properties, driving for dollars. One of my favorite attorneys. We all know them. Do you know probate attorneys, divorce attorneys, bankruptcy attorneys? Great lead sources to go after. Neighbors, colleagues, friends. Look, fill in the blank. If I asked each of you, you could all give me another reason right here. So I like starting with saying, hey, this is where you can find them. They're everywhere. Because the number one complaint is I can't find deals. Right now, that's the furthest from the truth. There are so many deals out there to be had right now. What's going on? Okay, so next question is, how much can I borrow? So Paul, how much can I borrow for the your realtor? Perfect. Your clients might come to you, right, and say, well, how much do I need to bring to closing? How much can I borrow for this? This is an easy formula that you can use every time. And it's simply money I need, money I get. You fill in these blanks based on the dollar amounts of the deal. In every deal that you buy, you're going to have an acquisition cost, are you not? If you have a rehab budget, put it in there. If you don't, put 0. And then whether you buy the house cash or with financing, you're going to have closing costs, right? So you always have a purchase price, you have a rehab budget, you have closing costs. And then the difference with hard money, private money financing, and I use those terms interchangeably, is the loan is based on the future value of the property. So after I buy it for $335,000, I put $85,000 worth of work into it. It's going to be worth $559,000. So we're going to lend you 70% of the future value. So 70% of 595 is 416,000. So money you need 436. Money your client can get 416. The difference is what? Is the cash deposit, $20,000. So your clients go, is this a good private hard money loan deal? Is this a good investment? Well, just run this. If it's got your client bringing $200,000 to closing, it's probably not. Now, we start off every time the same way. Someone calls Jason, says, hey, I have a deal. Jason pulls out pen and paper. Now we just do it in our head. But it's a line down the middle of the page, line across. Left side is money I need. Right side is money I get. And then we're writing down what it's costing us, a purchase price, rehab budget, closing costs, total. And then 70% of after repair value equals total. And then we fill the blanks. So this deal is a little different, but the concept's the same. Buying it for $145,000, 40 in rehab, closing costs, 70% of after repair value, $189,000. Difference caps to closing is $7,000. Now, this, I probably should not try this. So this is a shameless plug for our website. Up here, it says calculators. You're taking some pictures, which is great, and keep those in your phone. If you're like me, you go to events, take pictures, and they're just not of sorts. But you see the calculator, see on the left side? So again, we work with homeowners and investors. So these calculators apply to both. Here's a pre-approval calculator to see how much you qualify for. Here you can fill all this in. Jason worked this calculator out. We factor in all of the costs that you're not factoring. Things like your carrying costs on your electricity bill, taxes, insurance, etc. So anything that we forget or picture-wise, you just go to our website. It's the point of that. Top calculators, click there, and we just have tons of different calculators that you can go to. What's my payment is another question that we get asked. And another question that you as a realtor get asked from your investor clients. Super easy way. You take the interest rate, you divide it by the number of months in the year, 12 months. And then you multiply that by a loan amount. That's just the easiest way to come up with the interest rate. So $11.99 divided by 12 is 1% times 200,000, 2,000 bucks a month. If you have $9.99 divided by 12, it's 0.8325 times $24.98. Pretty simple. If I was to go back to the website, there's a place there that says, what's my payment? You can click there, you can type in the information. It gives you what your payment is. There's a website again. All right, how investors make money. Patrick, in real estate, you make money when you what? Buy. Put them on the.
Oh, thank you. That was my second choice.
So in real estate, you make money when you buy. We have clients that come to us all the time, and they're like, "Hey, I'm buying this house for $200,000. The rehab's $150, and the ARV is $400,000." I'm like, doesn't sound like too good of a deal. You're buying it for $200 plus $150, that's $350. Then you got carrying costs, and then you got selling costs, and then you got closing costs. Like you're not going to make any money here. And the reply is always the same. Well, maybe I can get the rehab done for $80. No, you're not. The rehab is what the rehab. I came in on time and under budget, said nobody ever. So the idea that you're going to take this big rehab budget and you're going to shrink it down because your brother-in-law is going to do the painting, or you're going to do some of the work, or you're married to your cousin, and because she's your cousin, she's going to give you a discount on the listing fee. None of that stuff works. The only way you make a deal a good deal is by buying it right, by buying it with the price right. So either a deal like that you walk away from, or you go back and you renegotiate. Now, I make a strong argument that when you have financing that is tied to the if you have financing that's tied to the acquisition, well, the financing that you get impacts the acquisition cost. Because if you get a good deal, but you get bad financing with it, well, all of a sudden that good deal can go bad. But if you have a good deal and you get good financing with it, well, then that deal should be a good deal. So financing will start with your credit score. Any lender that you reach out to, unless it's, hey, I mean, Patrick, if I went to borrow money from Patrick, I'm pretty sure Patrick would ask me what my credit score was. And Patrick and I have been doing business together for the better part of, what, 5, 6, almost 7 years now?
No,
So-
I'm not too worried about your credit score with a big down payment, more flexible.
That's de-risking the deal, right? And as lenders, we constantly want to de-risk the deal. Give me more skin in the game. And then any flaws that you have, I'm willing to overlook those. But those that have good credit, you kind of make it argument like, wait, I have really good credit. Do I have to put as much down? And then back and forth goes. But here, investors, unless you have every deal that you ever want right now already financed, I would constantly paying attention to where my credit score is. Because when you do get a deal, if you're going to flip it, well, great, that loan's over in 3 to 9 months. But if you plan on keeping that as a 30-year loan, that credit score that you have in a snapshot is going to impact your cash flow for the next 30 years. So I tell clients all the time, as you're looking for properties, keep an eye on your credit score. So that way you go, am I going to get the best financing that comes with it? Here are how the credit scores are broken out. Any mortgage company that you talk to, we're all the same way. They go, once you're above a 780 credit score, interest rates across the board. When I say are the same, don't confuse that. Every mortgage lender offers you the same rate. We all have our tiers set up this way. So when you're 780 and above, you get the best rates that any mortgage lender has to offer inside that company. Now, if you fall between a 760 and a 779, you get the second tier rates, and then so on and so forth. Why I have a line at a 680 is it gets just shifts a lot for what you're above 680 to below. The rates are in Jason and Ravi will I can go over that. How do mortgage lenders make money? Jason, Ravi, how do we make money?
Interest rate.
Interest rate, that's one. What's the other, Ravi?
Origination fees.
Just fees, right? Lenders make money, charge the interest that we charge on the money that you give us, and then all the fees that we charge. So, right, everybody that's ever got a mortgage before, you make payments every month, and then you pay some fees. So, we know that if you are to call us to ask us about our private hard money loan rates or terms of process, you're going to call and you're going to say something like this. What's your rate? What are your points? How fast can we close? And how much do you lend me, or how much do I have to bring to closing? It's a combination of that. And those are great questions. But there's more questions that we want to ask, because on the interest that we charge you, that one's pretty simple. No one really questions that outside of what you have the rate. They go, okay, I have to make that monthly payment. I got it. And then you move on. But then with the fees, there's 3 times that you're paying fees. And you want to be aware each of these 3 times when you're paying fees. And that's before closing, that's during closing, and that's after closing. So you're not paying your closing costs just one time. Actual fees one time. They're spread out, and you want to be aware of that. So before closing, what are those fees like? Application commitment fees, not so much, but appraisal fees, you're going to see those between $600 to $1,000 on investment properties. Now, at closing, this is when clients really tend to pay attention, which you should. All of these fees you should know well in advance before going to close. Now, you want to be careful because these private hard money loans are not regulated. There's no, I have to send you documents in advance, Jesus, so you can look at the terms. There's no regulation for that. Show up to the closing table, and that's what it is. So whose responsibility is it to make sure that you have the right terms? It's yours. It's mine. As the investors, it's ours, right? We don't ever want to show up to closing not knowing what we're signing when we get there. And then there's a whole other story with that. So origination fees, this is usually the bulk of it. This is when this is where points come in. So if you've ever heard the term points, that's an origination fee. So typically you'll pay between 2 and 3% on origination. Underwriting fees, processing fees, setup fees, admin fees, and then we've seen loan servicing fees. We've seen draw inspection fees. We've seen, it doesn't matter. There's a bunch of fees. Lenders get pretty creative. The thing is, you want to know before you show up. On our website, we have all of our fees listed on there. We're super proud of that because I bet you can't find a single other lender in the universe that has all of their fees listed on their website. After closing, this is really where you need to tune in. And you can't skip this step and then tune in after closing. Because once you close, you've closed. And then this idea of you didn't tell me, I didn't know, you're just going to be met with, well, you didn't ask, which isn't the right answer. But unless you ask, you're not going to know. And it's often not the answers that we don't know, but it's the questions that we don't know to ask to get the answers that we need to know. So after closing, we built our entire business on this, on saying, hey, look, investor, don't get hustled. Draw fees, inspection fees. We charge draw fees so many times I haven't listed twice. Servicing fees, wire fees, prepayment penalties, minimum interest fees, payoff fees, extension fees. I just want to walk through some of these. And I think I've actually got an example here. So you see all the fees. It's a lot of them. Let's just add up what that looks like. The big one is paying interest on your undrawn rehab budget. So paying interest on your undrawn rehab budget. If that doesn't mean anything to you, we'll hear in a second. So remember this? I'm using the same example from earlier. So you paid $600 for an appraisal, right? This rehab money, you do not get that money up front as a real estate investor. That money is withheld in an escrow account for you and is dispersed to you in draws. As you complete said repairs, you now get your money back. So you go and say, hey, I did the demo work and I patched up some painting. On my $85,000, I would like $15,000. So an inspector comes out, looks at all the work, says, you did it, great, here's your $15,000. That inspector is going to charge you a draw fee, on average about $200 each time you do it. So on $85,000, it's extremely fair to just assume that you're going to do a draw 4 times. Your life will never do more. Maybe you do less. We'll just assume 4. So 4 at $200. How much is that? $800, right? And then we had $600 for the appraisal. So we're at $1,400. Sending money isn't free. There's things like wire fees. And lenders will charge $30 to $50 to send you the wire. So now you have those 4 draws, right? Let's just do $50 because it's easy math. That's another $200, right? So right now we're at $1,600 in fees. And you didn't know this. You didn't ask because you're so trained, like I am, like we all are, to ask about interest rate and ask about points and ask how fast we can close and how much money do I need to bring to closing. So what a hard money lender does is, my rate's 10%. But now you're going to pay me all those other fees. So you end up paying a lot more, right? Now, this money, I mentioned, you haven't received this money. It's being withheld. So what's your loan amount right now? $416,000, right? That's how much money I get. I get 70% of $595, which is $416. So my loan amount's $416. But if I haven't got the $85,000, how much money do I owe you? I know my loan amount is this, but you haven't given me this. So I don't owe you this. So if I don't owe you this, Jesus, I'm not paying you money on it. I wouldn't pay Visa if they charged me on my credit limit versus my credit balance. I wouldn't pay Mastercard if they charged me on, my $20,000 availability versus the $2,000. So why, as a real estate investor, would you pay interest on $85,000 that you haven't received? Because you don't know better. That's why. Now you do. There's lenders out there that won't charge you interest on this. We're one of them. Now, remember the payment that we talked about? 1%, right? It came up, just use 1% per month as a payment. So if I have to pay money on $85,000 and I don't have it, what's 1% of $85,000? $850. So now I just paid $850 on a payment for money I didn't borrow. So I just went from, we were at what, $1,600 plus $850. I'm at $2,500. Now next month I borrow $20,000 of this, but I have $65 left. What's 1% of $65,000? $650. Now I'm at $3,100. And then I go to ask for a payoff. And then I go to ask, or I paid off early, or I end up extending the loan. So let's go. Do you have a question, man?
What if we don't borrow money for the, would you not pay? Because I asked that to another lender. I only have one investor that does hard money loans. Although the other ones are cash. But would y'all, if they just want to borrow for the property, not for the rehab?
We love that one. Love it. So I have an investor right now who's buying a property. It's in Dallas. He's buying for $205. The rehab on it's $120, and then it's worth I think $440. and he has cash, so he doesn't want to borrow the 120 from me, because these, especially contractors that have money, they just want to keep going and they don't want to have to worry about, hey, I did this, will you send me the money and do that? So in that case, what happens, I won't lend 100%. So I went to that guy and I said, hey, give me 20%, give me 10%, depending on the numbers, and they'll put down 20,000 or 40,000 by the time we get the ARB back, and then we'll just lend him on that. So his payment's only going to be on probably 150, 160, and then he can do the rehab budget himself. Right. And we love doing that with land deals, builders, developers, to where they find a piece of dirt that's just hot. It's like, this is going to sell. Well, you can use our private hard money financing. You can close in 3-5 days. Then you can turn around and go get your construction financing somewhere else, pay us off 1 month, 2 months, 3 months later, whenever you've got your plans, your permitting, and exit financing in place. Here are the questions. And they are on, they are on the website, of course. Look, we're going to charge you interest for the money that you borrowed, and we're going to charge you origination and underwriting at closing. We're not going to charge you fees before closing. We're not going to charge you fees after closing. We're going to charge you interest, and we're going to charge you 2 fees at closing. That's the website. So you wouldn't go shopping without your wallet, right? My wife and I are going to go to dinner tonight. I'm going to make sure that I can bring my wallet with me, at the very least Apple Pay. You wouldn't want to go shopping for a house without a pre-approval letter. And a lot of times you're going to reach out to your mortgage loan officer, and he's going to be at a 6-year-old flag football game. It's screaming fly, Eagles fly, and it's not going to be available. And you guys can't miss out on a deal because of that. So you go to our website, it takes you 60 seconds, you answer a series of questions, and you get your pre-approval letter instantly. I'm big into this. Never stop prospecting. For those of us in real estate, 80 to 85% of our time should be spent prospecting and marketing. The other 15, 20% of the time, we can do all the paperwork during that time. But 80 to 85% of our time needs to be spent marketing.
Okay. So yeah, DSCR loan. So DSCR stands for debt service coverage ratio. It's essentially the easiest way to kind of describe it is based on the property income, where what Jason's about to talk about, conventional loans are based on your own personal income. These loans, again, based off property's cash flow. The property must stay on its own, meaning the property has to cash flow whether it's rented out or not. And that's how the loan is qualified. It's designed for real estate investors who own multiple investment properties. And also, I've been working with a lot of self-employed borrowers that use DSCR type loans because they don't want to provide tax returns. They don't want to qualify with income. They've either written a lot of stuff off on their taxes, which is perfectly fine. But this is a really good strategy for that. I don't know if it's in the slides, but I'll mention a few other things down the road on it.
So conventional loan that is based off of both the property's cash flow and your personal qualifications. So this is good for W-2 borrowers, borrowers who are self-employed but have very clean tax returns, don't take a large amount of write-offs, have consistent income, things like that. You're typically going to get better terms on a conventional loan than you would on a DSCR loan. And all conventional loans are fixed rate loans the entire time, no payment penalties and things like that. So they're going to have reduced fees, but the process is a little bit more difficult to qualify for because it qualifies based off your income, just like you're buying a house to live in. Then also you get the benefit of the cash flow of the property to offset the mortgage payment.
So the basic formula for debt service coverage ratio, whenever you're looking at any investment property, you can always reach out to one of us to figure out what your payment is, or you can use a mortgage calculator on our website as well, because you'll just want to find out what that principal and interest payment is. And then you'll find out what the property taxes, estimated homeowners insurance, and then if there is an HOA, you're essentially adding all that up, and that is your the service part of the debt service coverage ratio, your monthly payment. But then you're going to take the market rent. So depending on what area the house is in, you'll see what is the house. You'll take that and you'll divide that by the full mortgage payment. And the thing to know is that calculation above one, meaning is your property cash flow positive or is it below one? And that kind of helps determine how much you can borrow, what is your interest rates. Mainly if it is above one, you can pretty much get the best terms that are out there. If it's below one, you can still get qualified even if the property is not cash flowing. But that's a very easy formula for it.
So just basically to recap on that, if you're renting the property out for $2,000 a month, one or higher DSCR means that the overall expenses is less than $2,000 a month. So it's kind of an easy way to explain that.
I'm going to be closing on Monday using the DSCR loan, but I just wanted to ask a question. Are all DSCR, do they all have prepayment penalties or balloon payments?
So no, and we will get into that a little bit more. No, they don't all have prepayment penalties.
Yeah, it just depends on which lender. Some lenders will have prepayment penalties. You typically will get better pricing if you do take a prepayment penalty, compared to if you take a zero, like no your prepayment penalty. But typically the ones that I've seen, I haven't seen one that has a balloon payment on there. Typically they're full 30-year, 20-year, mainly 30-year mortgages. Yeah.
Yeah, you could possibly have a private owner or a private bank to do those, but most of the what we would call institutional type investors that do it have pretty standardized terms with respect to those kinds of loans. So again, conventional loans use your debt to income ratio. If you have about a house before, you probably heard what we were saying DTI. It's just the ratio of how much income you make versus how much your total liabilities are. So when you're qualifying for a conventional loan, your car payments, student loans, housing, even for the houses that you have as other rental properties, calculate into your overall debt to income ratio. So again, buying a personal income along with the income of the property, it's really good for borrowers, your W-2 borrowers or an investor that's buying their first investment property, or if they're just very, very clean about how they file their tax returns and it don't take a large amount of line off some of the properties.
So I'll go through an example of this, kind of what Jason was talking about earlier. Let's just say if your market rent for the property is $2,500 for that home, your principal and interest payment, add that up with your monthly taxes, monthly insurance, and then if there is an HOA, you add that in. So then the total monthly payment is $2,051 on that. I saw it on the laptop. I didn't add that up in my head, but $2,051. So your net operating income, it's $2,500. That's the market rent for the property. You divide that by the 2,051, and then you'll get your debt service coverage ratio, which is going to be 1.27. So again, anything above that 1% is meaning it's cash flow positive. It's a good rental property, cash flow.
It looks like there's a little bit of typo there. It's supposed to be 25.
Yeah, but all it is market rent divided by your cool mortgage payment.
Is there room for rehab on these?
No, yeah, this is just traditional.
All of the appraisals that you do on these types of loans are going to be both value as is value and market rents. So even if you're renting the property out for more, they're going to do a comparable rent schedule and use the comparable rents for the property in order to calculate your debt to your DSCR. So it's not going to just, if you have a brother-in-law that's living in the property and pay $300 higher than market rents for it, you're not going to be able to get credit for that $300 higher in market rent. It can be the lower of the two, the current rental amount or the comparable rents.
So 1,700, basically the whole calculation here is take your market rent divided by your monthly payment, principal, interest, tax, insurance, and HOA, and it's very easily, is it cash flow positive or is it not?
So in this example, let's just assume you make $10,000 a month or $120,000 a year. We factor in your principal and interest payment for the mortgage, the property taxes of $350 a month, the homeowner's insurance of $200 a month, and then you have other liabilities of $750 a month. We add all of that together, it gets to $2,500 a month. We divide it by your pre-tax income of $10,000, and your debt to income ratio is 25%. Typically, we want a debt to income ratio under 50% for a conventional loan. So the way to kind of calculate it if you're buying a house is take your pre-tax income, divide it by 2, subtract anything else that you have on your credit report. That's credit cards, student loan payments, car payments, installment loans, anything else like that. And then whatever's left over is how much you can qualify for a mortgage payment. Now, if you're buying an investment property, that investment property, the rent that you're receiving for that investment property will offset the mortgage payment, but it won't offset it 100%. So if you're buying a new investment property, let's say you're buying a turnkey ready house and you're buying it for $200,000 and it rents for $2,000 a month. Well, we're only going to factor in 75% of that rent because of vacancy factors and repairs and things like that. So you're only going to get $1,500 worth of credit to offset that debt. And then if you're buying an investment property, you have to have your primary housing obligation factored in as well. So let's say you're living in a house that's $3,000 a month for principal and interest, taxes, and insurance. That $3,000 a month would be factored in. and then you've got the $1,500 a month that you're making to the other one. Well, let's say the mortgage payment's $1,900 a month, so you'd be negative cash flowing $400 a month on that property. You got to factor in all of that numbers and then divide it by your pre-tax income. And if it's under 50%, you can go use it. Here it is an example. So property rents for $2,000 a month. Principal and interest is $1,200 a month. Taxes at $350. Insurance is $200 on your tax returns. So this, let's say this is a refinance of your tax returns. You wrote off $480 a month in depreciation, because if you're a real estate investor, you know that depreciation is a great tax benefit to being able to do it. It is one of the few things that you don't actually pay if we can factor back in to the calculation to offset the rent. When you file the income in your tax return, we can use 100% of that income if it's a history of you receiving that income versus, you know, a prospective rent that you're going to be receiving that could have a vacancy factor. So the way Fannie Mae looks at it is, hey, they've already rented this house out for the last 12 months, so we assume that for the next 12 months they're going to rent the house out as well. So depreciation can be added back in. Things that cannot be added back in is commissions for real estate agents, repair costs, travel expenses. All of those things get deducted from what you use to calculate your rental income. So it's a really good idea if you own one or two investment properties to talk to a mortgage professional after you have the freelance copy of your tax returns for a CPA. If you're looking to buy a new investment property, have your loan officer look at the tax returns and see if there's something else that might be able to be kind of massaged or moved by your CPA to help you qualify. Because at the end of the day, you know, let's say your effective tax rate is 15% and you wrote off $3,000. Is that $450 to save in your tax bill really worth not being able to buy the next investment property that you can make $5,000 a year off of with respect to cash flow, appreciation of the property, tax write-offs in the future, and things like that? So it's always really a good idea if you're a real estate investor before you file those tax returns. If you're wanting to buy, you know, if you're not wanting to buy a house in the next 12 months, trust your CPA to do what you want to do. But if you're looking to buy a house in the next 12 months, we're going to use the most recent year's tax return. It's really a good idea to have your loan officer take a look at it and see how it affects you. If you have enough income that it doesn't matter either way, we'll tell you, but you know, it's always a good idea.
So going back, go ahead. Sorry.
The first conventional loans you go out for VA, FHA.
Yeah.
So yeah, we do all those types of loans except for VA and FHA. USDA are typically primary residence loans. There are FHA refinances for investment properties. If you had an FHA loan moved away and then want to refinance that, FHA does have a product for that. But typically, your VA and your FHA are just going to be primary residence loans. Same thing for USDA.
So to kick it back to DSCR, you can typically get DSCR interest only, and you have the option to do principal and interest. So you have two different ways that you can go about it. Interest only, if you could choose that to help you lower your monthly payment to maybe get you above that 1% ratio. It does include prepayment penalties. Typically, it's actually 1 to 5 years. We also have options to where you can choose not to have a prepayment penalty either. And I think we'll show you here in a little bit the difference from choosing a 0 to 2 year or 5 year. Best rates are available at 30% equity, whether you're buying the house, putting 25% down, or refinancing up to 70% instead of going to the full 75, 80%. It is available up to 80. The other thing that's not on here is DSCR, you're able to close in an LLC. Compared to conventional loans, you're only able to close in your personal name. So that is one advantage if you're wanting to have your investment property in the LLC as well.
When you say best rate, we're talking about 7.25.
So we'll get into it. We have some pricing charts that we can kind of show you. Kind of imagine a seesaw at playground. Rates on one side, fees on the other side. The lower your rate is, the higher the fees are for the loan. So we make the same on all the loans we do. And so it gives you the option for, hey, how good of a rate do I want to pay versus how much? You know, like if you're doing a BRRRR strategy, where we talked about buying hard money, getting a hard money loan versus property and then rehab the property, you might have enough equity in there to buy down the interest rate to make the cash flow better for you long term. But you might not have the cash flow and might not want to bring money to closing on that refinance, or when you're purchasing the property, you might not want to pay an extra $5, $6, $7 at closing, depending on the purchase price. And so it just really depends on what the best overall scenario is. But we'll go through, I priced out options on Friday, so you'll have the most recent rates for the different loan options.
So typically, a little lower the loan to value, it's just de-risk the deal. that typically will get you better rates compared to going to all the way up to like 80%. So if you have a little bit more equity, you'll typically get better rates.
But just quick to answer your question, rates all the way down to 6.5%, all the way up to 8%, just depending on a lot of different factors. So conventional loan,
Sorry, and that is on the interest payment option. For how long? How does that work? So is there additional requirements? So that's putting into an LLC.
the only additional requirements on the LLC is it depends on vesting, on how long you have to have vested. Like if you're getting cash out, if you're doing a rate return refinance or a purchase, the only additional qualifications is proving who owns the LLC. Because at the end of the day, even though the loan is in the name of an LLC, it's still personally guaranteed by the borrower. So your credit report is still being used, and you're still signing something saying that you're liable for the debt. So the debt is in the property is in the name of the LLC, but you're a guarantor of the debt. So really, it's just showing who's the ownership of the LLC. In order to be the person guaranteeing the loan, you have to at least be 51% owner of the LLC. It's a purchasing the property. So you can't, have a gigantic LLC where you're a 10% owner and 90% somewhere else if you're qualifying for the debt.
And with regards to the interest only payment?
Yeah, so there's two options. There's a 30-year option, a 40-year option. Both of them are going to have a 10-year interest only period, and then the loan is fully amortized after that period. So on the 30-year option, you're doing 10 years of just interest payments, and then after that 10 years is up, the loan re-amortizes and your payment is recalculated based off of a 20-year amortization. The interest rate stays the same. It's still a fixed rate loan, but you're just paying a 20-year loan. Majority of the time, especially if you're an investment property, you never want to get out of that. It's just only period. You want to either refinance or sell the property during that period because your payment will go up substantially after that time frame. So go ahead.
Do these interest only, are they always coupled with a prepayment penalty?
No, but the rates are going to be much higher without a prepayment penalty on an interest only loan because all of those factors are more risk for the investor. The higher the risk, the higher the interest rate's going to be for you. So any other questions on that before I go on? Conventional loans are fully amortized, which means there is no interest only period. There's no balloon period. There's no prepayment penalty. We really suggest that you don't buy a property as an investment rental property and then relist it because there's a thing called BRRRR where they keep track of borrowers and what they're doing. So if you're doing things in order to kind of circumvent rules with respect to loans, then you can have a hard time getting financing later. Obviously it's based off of intent. And sometimes you might intend to hold a property as a rental property, but then value's still up 30% in 3 months, like happened in 2022. And you're like, hey, I just want to sell this property and cash out on it. You can do that. It's just if you repeatedly do that over and over again, lenders will flag you for it. And it's a nationwide system. So every lender will be able to see it once you do that.
Go.
So let's say we get into a DSCR and then I like to take some home equity.
Sure.
That is, then we can do that. So
Yeah, typically for DSCR, you have to be on title for 6 months to then be able to take any kind of a cash out. And typically you can only go up to 75% max if the property's cash flowing and things like that. If it's not, then you're kind of limited to 65%. Now there's a caveat to both conventional and DSCR if you were to buy the property cash. Then you can take your equity out right away within the 6 months up to your purchase price and repairs as long as it's within the 75%. Yeah, so it's just depends on how you purchase the property.
But if you purchase a property with a DSCR loan and a prepayment penalty, the only way that you'd be able to get equity on after you get up on the loan is to do a home equity line of credit. So you got to find an investor that would do a home equity line of credit or a second lien financing. It doesn't have to be a line of credit. It could be second lien financing. But the prepayment penalty is kind of designed to prevent you from replacing that loan. And we'll get into what the prepayment penalties are when we get into pricing and everything else. Any other questions on the conventional loan?
So this is just an example. It's on Friday. Pretty much the big thing to look at is that 70% loan to value and the ratio is above 1. So the whole calculation that this property is cash flow positive. It's a 30-year fix and has a 3-year prepayment penalty on there. So typically you're going to see interest rates are ranging from on the high end at 7.5%. It comes with a lender credit. goes down to 6.75, where you're paying about $2,100 for that rate. So you can see rates for DSCR. I know a lot of people think they might be potentially higher than conventional loans sometimes, but if your property is cash flow positive and you're at 70%, I think this is based off of a 780 credit score. You can still, as of Friday, you can get into the low sixes by paying a little bit of points to get that rate. But the big kicker is that it's above a 1%.
And I just wanted to highlight, so the bottom line says no additional lender fees. So a lot of lenders, most borrowers, when they call us, they say, what are rates? Like, that was your question earlier. What is rates? Well, you know, a lender might say, hey, we can get you 6.25%. They're charging you an underwriting fee, a processing fee, discount codes, an admin fee. I mean, we've seen so many other fees put in there. This is with no lender cost at all. Now, there are loan costs, which are a little different. You pay credit report fee and appraisal fees, things like that. But we're not charging you any fee, and the investor that we're sending the loan to is not charging you any fee at these interest rates. So if you're familiar with the loan estimate, box A of the loan estimate is 0. Providing there's not a discount in here. So, I mean, yeah, these rates are very comparable. Conventional loans will get into conventional pricing as well, but it's very comparable. The three-year prepayment penalty, 70% loan to value, and a debt service coverage ratio over 1.
So do you offer, if I had a loan estimate, another lender, I brought it to you,
Yeah.
you'd be able to compare it and analyze it?
We do that all the time.
Yeah.
We love doing that. Where I see it the most is with builders, and a lot of times we can't compete just because the builder owns the mortgage lender and they can pull both covers. And so like a builder will offer you a $30,000 credit if you use their lender. And so, we're making 2% of the loan with probably a max of $6,000. So if we're making $6,000, I'm a space to offer you $30,000 in credit for UCFs. But we will go in and say, hey, look, they're charging me this, this, and this. Maybe you can get this down and things like that. And that's with us not even having a chance to do that. So we love this opportunity because we can actually earn a lot in our business this way.
So as I mentioned, I'm going to be closing on Monday at 3 p.m. using a DSCR. It looks very similar to this. So it's kind of the 11th hour, but I was just wondering for future, right? And this is a loan company that I've used often, multiple deals and things like that. If you could do an analysis on this and give me a better price.
Yeah, the big challenge with that is that pricing is very dynamic. When I say dynamic, I mean interest rates can change 3 times a day, especially like the days of the Fed meeting. We've seen rates improve all the way up to the Fed meetings. Then the Fed drops interest rates, and then Jerome Powell gets in front of everybody and says how terrible the economy is, and interest rates go up by 0.5% on fees. So the same rate on a $400,000 loan just after the speech cost you $2,000 more in 5 minutes after the speech. So
I'd be more concerned about the fees and so forth.
Yeah, typically, whenever you get to your next deal, if you get a loan estimate, you can just email it to one of us, and we can go over it with you and compare it to what you can do. Yeah, very easy.
this is the next one.
So this is another scenario. The big difference here is that it's the exact same loan to value. DSCR is cash flow positive, but this has no prepayment penalties. So you can see on here, the lowest rate you can get a 7%, and it's going to cost you more than what it was previously with the 3-year prepayment penalty, to where the par rate here is 7.5. And I think, could you go to the slide before, where par rate here is essentially 7%. So taking that 3-year prepayment penalty or not having one, it's about 0.5% in this scenario difference in interest rate.
And what the prepayment penalty is typically is on a 3-year prepayment penalty. In the first year, it's 5% of the loan amount. The second year, it's 4%. And the third year, it's 3%. And then after that, it completely goes away. A 5-year prepayment penalty is the same way. Steps down from 5, 4, 3, 2, 1. 1-year prepayment penalty is 5% for the first year and then goes away. So this is a conventional loan. Same appraised value, same 70% loan to value. 30-year fix, no prepayment penalty, no additional lender fees. You'll see that the rate is actually better on the DSCR loan, the 3-year prepayment penalty, than the conventional 30-year fixed loan. This is basically in between those two loans. So in order to get close to what a par rate is, par just means that you don't pay anything for the rate or you don't get any credit. You'd be getting a 7.375. So it's about an 8% better than the DSCR loan in the same scenario, and it's worse than the 3-year proof that you built. And then this is the conventional with 75%. So you'll see that why we say you want to put 30% down, it's about an 1/8% better on the interest rate if you put an extra 5% down. But it's not just the 1/8%. If you look at the overall pricing differences here, you'll see that it costs you about $800 to borrow $12,000. So you're almost paying, what is that, about 6% on your money just to borrow that money. So, it's really up to you whether or not it makes sense. Those numbers change quite a bit based off of credit score. So this is really top tier credit stuff. If you got below, let's say, a 720 credit score, those numbers really spread out quite a bit between 30% down to 25% down.
So whenever I'm talking to clients about DSCR loans compared to conventional, it is less documentation to provide upfront as far as getting qualified. So typically I will ask for just IDs. This is on a refinance per se, right? If you're trying to get out of a hard money loan and into a long-term loan, it's really just the ID, the mortgage statement of your hard money loan, property tax statement, homeowner's insurance policy. If there is an HOA, I need the HOA, and then just essentially the property survey and the name of the title company. So it's very limited on the documentation that you need for a DSCR loan because I only need it for that specific property. I don't need tax returns like I mentioned, pay stubs. I don't need any mortgage statements, taxes, insurance, anything else on all of your other properties as well. It's solely, again, based on the property income, and we think it's perfect for real estate investors because you're not having to provide all those other documents for all of your other properties. And at the end of the day, it is going to be based on the market rent. Whenever we get the appraisal done, it's going to help determine the value of the property, and the appraiser is also going to let us know what is the market rent for that home, and that's typically what we use for the ratio.
So we typically tell every client, hey, this is a estimate based off of the information that we have. It can vary wildly happen with that appraisal that. It's literally like, hey, this is what we think it looks like based off of the numbers that you're giving us. But if that appraisal comes in any different on the value or the rental amount, we're going to have a different conversation. And sometimes, especially getting out of a hard money loan, a lot of times we see getting out of the hard money loan as a borrower that was intending on flipping the property. And as we all know, the market kind of turned quite a bit. And so they're not able to sell the property. So they've decided to convert it to a rental. And a lot of times the numbers aren't great because if you're buying a property and flip it, you're not looking necessarily at what it can rent for. So especially your higher value properties, $400,000 house, the mortgage payment is going to be higher than what you can get for the rent for. So sometimes it's threading the needle of figuring out, hey, what is the best cash to close that we can do? What is the best they're doing interest only to make that DSCR above 1%? And we really won't know all of the information to be able to have those conversations. We could have those conversations up front, and we do kind of the baseline level, but it's really hard to say, hey, here's 5 different options based off of 5 different scenarios of the way the appraisal will come in. So we kind of give you our best good faith of what it will look like, and then once we get the appraisal back, we kind of work with you to figure out what it will look like at the end of the day.
Are DSCR loans only for viewing purposes, or can it be used to like refinance take equity out of the property you already?
Yeah, it's for purchase, refinance, or cash out refinance.
Mm-hmm.
Yeah, all 3.
Yeah.
But only for investment property, so nothing with primary. Yeah.
Can it be only for short-term bond? It can, right?
Yeah.
Did you say one for the investment?
Only investment properties only.
And I haven't heard it into the program house. If I get it rented out, would I fly for a DSCR?
The challenge on those is that you're going to have comparable rents for the property. So when you're converting a property into a high value rental, like let's say like a long-term care facility or something like that, right? You might have a 4-bedroom house that you now have 80 people living in. It's bringing in $7,000 a month. Now you have to do a lot different rehab than normal people have to do with respect to their investment properties. But unless there's other properties that have rented out during that time frame, the challenge is the appraiser is just going to use publicly available data. So they're not going to be able to go into other long-term care facilities in the area, find out what the payment is for that, say, hey, this is what the going rent is for that type of property. So you're very likely not going to DSCR on something you're converting, unless you can buy comparable workforce.
What if you rented it out as something else for a year and you had a track record of all your?
So again, the investor has to lend the money out based off of the comparable rents and your rentals. And they're going to take the lower of the two because they're going to be more conservative with it because for whatever reason, maybe you can't anymore. Maybe there's a liability issue or something like that, that you no longer can rent it out the way that you were renting it out. Then really the best route for that type of loan would be like a small business loan or a portfolio loan with bank holds. Is typically the best way to get your full bang for your buck on the rental receiving. What I would recommend, and we can talk offline about this, but what I would recommend is having that property in a separate tax entity and file taxes based off that property. Then you can use the net operating income for that business to qualify for a business loan. It's based off the real estate and the business itself. It's more of a commercial loan.
Asking this. I have an investor. She got off our money loan, and then she refinanced with the DSCR loan, and now she wants to sell as a RAC owner financing. That's her futures for whoever tries to buy the house, right?
You're going to run the same risk on any type of wrap. So if you're familiar with wraps, it's the same works. It's the same do one sell clause. So in a wrap, you in your promissory note that you're signing when you close, it says that you're intending on keeping the property in the same name that you got the financing under. So the title can't change along with the note change, according to what you're signing on your promissory note. So when you do a wrap, you do it the legal correct way. There are people that will do wrap when we don't take the title out of their name, which is very unethical and illegal matter. But if you do it the correct way, you're changing the title. If the lender touches it, like the servicer of the loan touches it, they can call the note due within 30 days. So then you have to either sell the property or refinance the property within 30 days of that time frame. And it's the same risk for DSCR or any other type of wrap.
I've heard of two other types of it's mortgages. Is that portfolio loan?
Right.
And a statement loan, so it's called.
Bank statement.
Yeah. So and what at least with the portfolio loan, people I talk to allude to that it's a type of DSCR. Is that correct or is it very different?
So a portfolio loan is a commercial loan. DSCR loans kind of mimic commercial loans. A commercial loan takes into account your net operating income. So it takes the overall income minus the debt service, or not minus the debt service, minus some other factors, and it factors it in with the debt service. So it's kind of a DSCR, but it's a DSCR based off of the net operating income for the business. So portfolio loan is just a generic term for, hey, we're keeping this loan in our portfolio. But what most investors see it as is like a type of loan where you have a blanket loan. You have 4 or 5 properties under one loan, and it's under a portfolio of business. And what they'll do is they'll look at your overall cash flow, kind of a business would, and then they'll factor that in. But then they'll also factor in the value of the properties as a whole, and they'll kind of do both. It's the same thing if you're buying a commercial real estate property. You can't buy a commercial real estate property for more than the value of the property itself or the net operating income to the business.
So do you offer blanket loans?
We do not.
Okay. And my understanding of the statement loans is for individuals who, for example, Paul talked about where you file your W-2 and you take out all sorts of deductions and she doesn't show, if you make a lot of money that year, but you can provide, I think it's 12 months of statements and it shows all this, the income that's coming in, right, and you'll lend on that, based on that. And
Yeah, exactly.
We've seen that more for primary residences than investment properties. I don't know if you're familiar with
So,
that investment.
Yeah, so I mean, it's the same concept as a primary home, right? As long as you can show 12 months and you're self-employed, like your business owner, you show 12 months of your business statements. And then the underwriter will take an average daily deposit the last 12 months and calculate your income based off of that. So obviously it would be a lot higher than your tax return that you might have written a lot of things off. Yeah, so what I'm doing one for a primary home right into a refinance. He did a new construction home and now he's moving into it as a primary home. And then I had another client use the exact same bank statement program, put 20-30% down and buy an investment property using the exact same formula. Yeah. So it can be used.
But bank statements are the interest rates are a little bit higher than if it was a DSCR loan, right?
Correct. Yeah.
So it's better than DSCR.
Yeah. It's just depending on, DSCR is strictly just for investment properties. Some clients have bought it for a primary home.
If you're a business owner, you kind of have to make a cost benefit analysis. Like, hey, my business brought in $1.5 million last year. My tax rate is going to be 30% on that money. Do I want to pay, $450,000 in taxes, or do I want to claim $700,000 in income, save at $200,000 in taxes, and pay $15,000, $20,000 more interest on my home this year? So it's just kind of a cost benefit analysis on that. Which way is the best way to go for you with respect to that kind of stuff?
So I guess I feel like you've gone over a lot of this stuff. So I don't know if anyone has any questions about DSCR loans, but it's pretty much the thing to take away is from DSCR is based on the property income. It has nothing to do with your personal income at all. And it's for investment properties. It will have prepayment penalties typically, and you can close in an LLC. That's sort of the summary of debt service coverage ratio at the end of the day.
And then one other thing on DSCR loans is you do have to have a primary housing expense. That is a very big kind of stumbling block that we have to overcome sometimes. And you have somebody who lives with their parents, but they have an investment property and they don't have any proof of any kind of rental income or rental payment, then it's really hard to get a DSCR loan with respect to those. It's not impossible to do it.
On a purchase. Because on a refinance, you can, like if you have a hard money loan, because you have ownership. The big thing they want you to see is if you have ownership history of a home. So typically if you're in a hard money loan, because I've been able to do a few of these, because you typically have a hard money loan for 3, 4, or 5 months. They just want to see that you've owned a property in the past 2, 3 years. And so a client that I have that is living rent free, he's been able to buy it with the hard money, rehabbed it, and then refinance out of DSCR because he has a payment history. But what Jason's saying is if you live rent free and you're trying to buy an investment property using DSCR, then it's first time home buyer, essentially is what they call it. That's typically very tough to do. Yeah. So pretty much you want to use DSCR. If you're a real estate investor, you don't want to show any of your personal income. You have multiple properties and you don't want to have to qualify based off all the tax returns with rental income. It's a lot easier documentation. Closing an LLC is typically another reason why I see it, but typically it's real estate investors, less documentation, and closing the LLC. Those are the 3 main reasons why, like the clients I've worked with, are closing a DSCR.
So what if you close not under an LLC? Can you later move it into an LLC without any issues?
It's the same thing that what Jason talked about. Is
it probably not? So you're saying you buy the property in the name of your personal name and then want to transfer it in the LLC before refinancing?
Well, just
as you own the property.
Yes.
Yeah.
Yeah. So if you want to get a new loan on the property, there's no problem. With the current loan, you have the same risk as somebody doing a wrap. It's the same risk. Now, if you go swimming in the ocean, there's a risk that you get bit by a shark. I've never met anybody that's been bitten by a shark, but you hear on the news about people that get bit by sharks. So, really talk to real estate attorneys before you do anything with respect to those kinds of things, kind of get their opinion with respect to those kinds of things. I would hate to tell you, hey, don't worry about it. And then your servicer calls you and says, hey, do not do. You're calling me and saying that you said not to worry about this. So, I know a lot of investors do it. I don't know a lot of people that get paid for doing it. I do know that if you're going to go that route, the insurance is the biggest thing that flags everything. You need to have an insurance agent that understands what mortgages and sets up the right insurance with respect to it. Namely, you have to have a person that's on the additional note be an additional insurer. And what happens is the insurance company, especially if the property's escrow, the insurance company will send their insurance statement to a mortgage company and the names won't match who the insured is with the mortgage company. And then they'll start doing a lot more research with respect to why they don't match. And that's usually where you get tension with respect to that. Conventional loans, first investment property, high minimum loan debt. It's going to be, if the loan is an easier overall loan, then conventional loans are probably the best route overall. And kind of answer the questions and answers. Do y'all have any other questions regarding Paul's presentation or anything else that we can answer for you?
So again, referencing the DSCR, my current lender actually did require mortgage statements, I think insurance and all that stuff for my other properties. What Why do you think that I guess it's not a feature of DSCR, it's just the.
Yeah, so the times that I've had to request mortgage statements for other properties is if that liability isn't showing up on the credit report, so they can't check the housing history, because you still have to have perfect or not or maybe 1 30-day late.
The last 12 months.
But typically they shouldn't be asking for insurance and taxes on your other properties. It's really just a mortgage statement that they want to see, just to make sure that you've been making your payments on time.
And sometimes, you know, investors have overlays, and a lot of investors are overly conservative, or, I mean, to be frank, to an underwriter or a underwriter assistant that doesn't know what they're doing. They underwrite multiple types of loans, and so they don't know what they're doing, and they ask for all things. So working with an experienced broker, they can push back on those kinds of things and say, hey, you don't need these. These are your guidelines. Here's a printout of your guidelines that says specifically you don't need this. Because a lot of times lenders will they will be like waiters for underwriters. So you got the underwriter back in the kitchen, you know, they're taking the order and then they're making the food, and they're just sending the food back, right? Well, a lot of times mortgage lenders don't have a lot of experience pushing back with underwriters, and they just ask for whatever they ask for. And, you know, also sometimes you'll have lenders that provide too much documentation. You know, underwriters will ask more questions if you give them more information than they need. I'm not providing an underwriter anything except for a credit report. And if the credit report doesn't show the current 12 months, because a lot of times if you're making your payments on time, your servicer's being lazy, and your credit report, if you look at a copy of your credit report, it might have the last payment of the mortgage is 3 months ago, just because they're just lazy in their reporting. So we might have to show the next 2 months mortgage statements just to show that there's no late fees or double balances on there, to show that on the mortgage statement side. But there shouldn't be any reason for taxes or insurance on DSCR loan, because it literally is just the debt service coverage of that property itself.
What factors do y'all look at? I just closed yesterday on my first fix and flip.
Nice, congrats.
So it sounds like we should have had this like a month ago.
It was cash. It was cash. But I kind of want to do like now, like, hey, you know, I want to go one cash and one maybe why wait,
Sure.
right?
Right.
So what does it take for me to get, if I was to say, hey, I want to go hard money loan for the next fix and flip? What are the requirements you have? Like, so that I can get a 2% origination point instead of 3.
So we do 2.5 on most of our deals. It's most of them. Usually it's going to be a very de-risked deal. So like, let's say you wanted to buy a property and put 30% down on the value of the house. We might go down 2% and then not do the rehab budget at all, kind of thing. It's going to be a factor of risk. I would expect to the overall thing. But I will say the difference between us at 2.5 and another lender. If you go on our website, we charge $12.95, and that's the only upfront fee we charge. We don't charge for an appraisal. We don't charge for any processing fees, admin fees, anything else like that. It's just a $12.95 fee. So if you're buying a $200,000 house and you're paying $3,000 in fees for a hard money lender, well, you're paying an extra 1.5 than what we're charging either way. So even though we're at 2.5 points, if you're paying an extra $2,000-$3,000 in fees, we still might be lower than that origination fee might be.
So you don't charge any admin fees or processing?
It's just a underwriting fee of $12.95. That's That's also on our website. You want to look at our fees on the website. Also, it's on like Paul said earlier, we don't charge any draw fees during the process, and then we don't charge any interest on your underwriting rehab budget. Which if you have like $85,000 rehab budget, you know, if it takes you 2 months to do your first draw, that's $17 there. So, I mean, everybody always wants to ask about points and fees. So a lot of lenders have got creative hiding their points and fees. They'll do fees during the process. They'll do other fees for servicing, things like that. We've seen up to a 1.5% charge for servicing upfront. Oh, we're not charging any points. This is a servicing fee. It's like, it's the same thing. Why do you care? Why do you care if it's called an origination or a servicing fee or something in closing?
I think a few things that Paul maybe forgot to mention, but we also offer free extensions as well on our hard money. So if we give you a 6-month term, hypothetically, if you were to go past that, we offer 2 free months extension before you get hit with an extension fee instead of getting hit right away. And then as long as you've been making your payments on time, your interest rate will never change, even if you have to extend. Or some lenders they'll like, okay, we'll extend it for you, but now you're going to go from like 12.99 to 13.99 or something like that. Our interest rates will never change unless you go into default.
And then also on that extension fee. So the extension fee is a 1% fee for every 3 months to extend. So you pay 1% plus you're paying the interest. But let's say you take 9 months, right? So you get your 6 months, your 2 free months, and you sell it in month 9. Well, we'll prorate you back in your payoff for 2/3 of that 1% fee. So you'll pay that 1% fee up front, then you'll get refunded for the time you didn't use it. I don't know any other this would do that.
So is there a limit on the number of DSCR loans that you can have at one time? That's one question. No? And then the second question is, if I'm looking at a property that is kind of, I guess, unconventional now. I don't think it can be that easy to find and do a comparison. It's a 15-acre property with a triple wide mobile home. It's got some additional structures on it. So how would you handle, and would that be conducive to a DSCR loan?
I feel like DSCR might be tough. We'd have to talk to a couple of other local departments that we work with that might be more in the commercial space. Because if there's more than one property on there, especially with, you said it was a triple wide and
On the triple wide, it's got some like a kind of like a shop, even with a structure, and then, yeah, it's more like rural. It's more rural.
Yeah.
Different structure.
I mean, it is very unique. I'd probably have to look into it a little bit further. Like once I know the
You would have to look at these comparable rental split, and then the types of structures really matters. Typically DSCR doesn't want to do manufactured homes, or some investors will do it, but typically they're not wanting to do manufactured home. And then also, if you have multiple manufactured homes, a lot of times what an investor will do very wise to let they purchase the property. Like, let's say I have 10 acres and I live in the back of 10 acres. I'll go buy some used, mobile homes and put it in the front of the property. Well, those property, they're not part of the real property. Legally speaking, they're not attached to the properties. So a lender can't lend based off of them because legally speaking, you can move this off of the property and it's not. So they can't really, factor in those rents because it's not factored in the market. So you have to have them taxed. It would be a very complicated scenario. Well, I really appreciate y'all's time on Saturday.